Hey guys, welcome back. We are on Unit 4, the financial sector. We're focused on banking and the expansion of the money supply. Now this is part 3 in subunit 4.4. In this part 3 video, guys, we're going to be focused on how the Fed kicks off the money expansion process. So this is a very important video because, guys, at the heart of Unit 4 is monetary policy. Monetary policy is something that is controlled by the Fed. The Fed is America's central bank, okay? So central banks in countries, once again, the Fed is the U.S. central bank, they control monetary policy. What is monetary policy? Monetary policy is a manipulation of the money supply to help stabilize the economy. So the Fed, what they're doing is they're going to influence the money supply in the economy. The way they're going to do that is they're going to work through the banking system. Now, for this video, I want you to assume that the U.S. economy is in a recession, okay? Spending in the U.S. economy is therefore depressed. We're not spending as much. That's what happens in recessions. And so what the Fed wants to do to help stimulate the economy is they want to push money into the economy to try to get more spending happening, bring inventories down, production back up, and hopefully employment back up. And what we're going to be showing in this video is kind of the mechanics of how they do that. So I've got the Fed right here. Once again, there's my banking system. I've got Bank 1, Bank 2, and this just kind of represents that there's a heck of a lot more banks out there. And what I'm going to have the Fed doing is just interacting in this video with Bank 1, just to get the basics, okay? Now, what is the Fed going to do? They're going to create reserves. Now, guys, that is so key. They are going to create reserves. Guys, the number one power of the Fed is their ability to create reserves out of thin air. What they're going to do is they're going to create reserves and they're going to put those into banks or try to get them into banks. The way that they're going to get those reserves into banks is they are going to buy U.S. Treasury bonds. Now, technically speaking, they can buy any asset from the banks to get their reserves into the banks, but the number one asset they usually buy are U.S. Treasury bonds. So they're going to buy an asset from banks to put an asset into banks known as reserves. Now, reserves, remember, they're not money. Why? Because reserves we always associate as an asset inside of the bank. That's what reserves are, is an asset inside of the bank. The bank can't use reserves to buy goods and services, so they're not money. However, what banks can do with reserves is they can lend them out. And once they lend them out to businesses and households, those reserves basically you can think of become money, okay? Not the reserves themselves, but the reserves give the banks lending potential, and those loans create demand deposits which allow businesses and households to buy goods and services. So the Fed's going to get those reserves into the banks so banks can make loans. Those loans create demand deposits, allowing households and businesses to buy goods and services. So let's take a look at how this is going to work from a balance sheet standpoint. So we've got bonds, U.S. Treasury bonds in the banks, and the Fed's going to buy those. So I'm going to write bonds right here. And I'm just going to make it really simple. I'm just going to make it $1,000. The bank is going to lose $1,000 in bonds. Now remember, or take note, guys, bonds are an asset to Bank 1. Remember, what are these bonds? These are U.S. Treasury bonds. These bonds are liabilities to the U.S. government, and they are assets to whoever owns these bonds. And I've got Bank 1 owning some U.S. Treasury bonds. And by the way, yes, banks do own U.S. Treasury bonds. So the Fed's going to buy those, so they're going to lose those bonds, and what they're going to pay Bank 1 with is reserves. So reserves at Bank 1 are going to go up by $1,000. Now it's also recorded on the Fed's balance sheet. Those bonds, when the Fed buys them, they become owned by the Fed, so they're going to be assets of the Fed. So we're going to put bonds right here, plus 1,000. And remember, again, the Fed just created reserves out of thin air. And where do these reserves reside on the Fed's balance sheet? On the liability side, okay? So what we're going to put is reserves. Whose reserves? Bank 1, reserves Bank 1, $1,000, okay? Or $1,000 worth of reserves. That's what the Fed's balance sheet looks like. Let me tell you guys, reserves 100% of the time are assets to banks, to commercial banks. And reserves 100% of the time are liabilities to the Fed. This relationship between asset and liability is always true, okay? Reserves are liabilities to the Fed and assets to the banks. So that was T1. One thing that I want you to note from T1 meaning transaction 1, is that no money was created from T1, what we say, immediately. No money was created immediately from this transaction, okay? This transaction in and of itself did not create money. It did not create currency in circulation, nor demand deposits. No money was created. But again, what was created? Reserves. And what can the bank do? They can loan them out. Here's the big question, guys. The RRR, let's say, is 10%. So how many of these reserves can they loan out? I'm actually playing a little trick on you. Who cares what the required reserve ratio is? They can loan out 100% of these reserves, okay? Why can they loan out 100% of these reserves? Because Bank One got these reserves by selling an asset. They did not get these reserves by taking on a liability. Remember, guys, the required reserve ratio, what does it say? It says, hey, banks, you have to hold on to 10% of your demand deposits in reserves. So of your demand deposits, you must hold on to 10% of those in reserves. 10% of your demand deposits you cannot loan out. Guys, they got these reserves by selling an asset, so they can loan out that entire amount. So let's go to T2. What are we going to have happen in T2? We're going to have Jim, okay? He's going to walk into Bank One, and he's going to take out a loan. So loan Jim plus $1,000, the entire amount. That's the maximum Bank One can loan out from this transaction that the Fed initiated. Jim is going to, of course, get money credited to his checking account. So demand deposit, Jim, plus $1,000. That, I'm going to put a star by. That is the creation of money. That loan created money. It gave a demand deposit to Jim. Jim can now go buy goods and services. How many goods and services? $1,000 worth. Now, that is the kicking off the process. That's the main thing I want you to get from this video. Now, I'm going to take it just a little bit further, okay, just to make sure that we really understand the expansion process, but that's the main point that we want to get from this video. Fed gets reserves in the banks by buying bond. The banks can loan out those reserves, hence creating money. Now, what we're going to have happen, just to take it a few steps further, Jim's going to walk out of Bank One, he's going to go buy something. Remember, we take out loans to go buy goods and services. So he's going to buy something, let's say that he's going to go buy something from Phil, okay? So he pays Phil $1,000, maybe he buys a bike from Phil. Phil, we're going to have head to Bank Two and deposit the money. So when Phil takes his check he got from Jim to Bank Two, they're going to record reserves plus $1,000 because the check was for $1,000. Demand deposit Phil, okay, plus $1,000, plus $1,000. Now, that check is going to get cleared, right? What is Bank Two going to do? They're going to send it to the Fed. And the Fed is going to do their check clearing thing. They're going to say, okay, a depositor at Bank One wrote a check to a depositor at Bank Two. I got to move $1,000 of reserves from Bank One to Bank Two. So the Fed's going to do that with their books. Then they're going to send the check to Bank One, say, Bank One, you get your books right. Bank One gets this check, says, oh, okay, one of our depositors wrote a check, somebody deposited money at Bank Two, here's what we need to do. We need to say, hey, I don't have these reserves anymore. Those reserves have been moved over to here to Bank Two, and Jim, you don't have that money anymore, okay? Now remember, Bank One's perfectly fine with this. They still have the loan. Jim's still going to have to pay back the loan plus interest, and that's the way the bank really makes money, okay? So Bank One's perfectly happy having that loan. And now that is truly the end of that transaction, okay? Jim walks out, buys something from somebody who makes a deposit. Reserves move over, and I just wanted to get to this point even in part 3 to make sure that we got it. How much can Bank Two now loan? Can they lend out that full $1,000? Heck no. Why not? They got their reserves from a demand deposit from Phil, okay? So the required reserve ratio does come into play here, okay? Hey, Bank Two, you can only loan out 10% of your demand, you have to hold on to 10%. You can only loan out 90%, okay? So you have to hold on to 10%, you can loan out 90%. That's the fraction that you can loan out. So we'll have somebody come in, we'll say Emily, she comes in, wants a loan. What would be the maximum loan that Emily could get? I'm just going to put an E for Emily. All right, it would be $900. Emily would be given a checking account, okay? So DD Emily, demand deposit, that's our checking account, plus $900. And what you see happening now is this money expansion process starting to unfold. Because what's Emily going to do? She's going to walk out, she's going to buy something from somebody, that person's going to deposit a check into a bank, reserves are going to move to wherever that bank is, and then that bank's going to be able to loan out 90% of that demand deposit. And the process is just going to unfold, and the money supply is just going to multiply. Whew, I hope you got that, guys. Once again, this was part 3. This is the Fed kicking off the money expansion process. This is how the Fed is trying to get money into the economy during a recession. Hope that made sense to you. We'll see you in the next video.